Are you able to see the chapter 5 now? Okay, good, thank you. Okay, so for the midterm exam, chapter 1 to chapter 4, I think the weight for chapter 4 is probably more than 50%, okay? So if you only have some time to study a chapter, make sure you study chapter 4, okay? So again, I'm helping you out with your anxiety, with the stress. If you only have a little bit of time to study, you study chapter 4, because I think the weight for the midterm exam is more than 50% on chapter 4. And I have good reason for that, right? Because that's a very important chapter, okay? So make sure you study chapter 4 really well, okay? Make sure you know, if you didn't do well with the chapter 4 quiz, the questions, make sure you know those quiz questions, okay? Chapter 5, cash and receivables. Cash and receivables. Okay, the first objectives from this chapter is we want to learn how to record, reconcile, and reporting cash and cash equivalent. You may be wondering what is cash equivalence, right? Maybe you didn't learn too much in the first intro financial accounting course, but we're going to talk about it in this chapter. And we want to talk about internal controls. And money is a good thing, right? Cash is a good thing, and nobody will disagree with me, right? Cash is a good thing. We all want to have cash. And in fact, I think we all kind of lack of cash, right? Doesn't matter how much you make, you always feel that you didn't make enough money, okay? So the internal control means, well, the company, you're gonna safeguard your cash, right? Your assets, right? So what kind of activities you have in place to prevent people from stealing your cash, right? So those are the activities we call, those are control activities, internal controls, right? To safeguard your assets. And we're gonna talk about, when we speak of a balance sheet item, so we talk about the 3 stages of the life cycle. It's just like us, right? You know, at the point you were born, and then you are growing, you are maturing, and eventually we are going to die, right? So we're going to talk about on the balance sheet, right? You have initial recognition, and the subsequent measurement, and then eventually there's derecognition. And in this chapter, this applies to all the assets. But for this chapter, we're going to talk about the trade receivables, okay? And then we left a little bit of time for the non-trade receivables in the very end, okay? So what is CECE, cash and cash equivalent? Okay, universally accepted media of exchange, right? Good stuff. Important to understand what cash includes and excludes. Sometimes when you think of cash, you think about the coins, the paper bill, right? But that's just the cash. There is also cash equivalence. Okay, so cash, okay, we all know bills, well, the paper bills and coins, okay? And transactions can be completed by checks, right? So you write a check to a landlord, right, to pay the rent, right? Bank drafts. If I buy a house, right, I had to pay a 20% of down payment in the amount of $100,000, right? That big amount of money, the bank will not just give you cash, right, to your hand. You have to get something called a bank draft, right? Bank draft or money order, something like that. So yeah, you can request for that, and then you can take that, give it to give it to the seller, right? And they deposit this bank draft, right? Wire transfers. So some of us are international students, right? Maybe your family is still supporting you right now. So when they send the money to you, right? They probably use the wire transfers, right? So they went to your home country's bank and exchange into Canadian dollars, and then wire these Canadian dollars to your bank account in Canada, right? Cash equivalence. So what do we call cash equivalence? So this is not cash, but we consider them to be equivalent with cash, right? In terms of liquidity, right? What's really make cash unique, distinct from other assets is the liquidity, right? So cash is the most liquid item, right? So then if you follow in that order, so some other items are very, very liquid, right? Not as liquid as cash, but they are quite liquid. They are short-term. They can be converted into cash within a few days, right? And with no risk, okay? So some of the examples would be commercial papers, treasury bills, short-term government loan with a maturity date of 3 months or less, okay? So these are the things we considered as cash equivalents. They are not cash, but they are very, very liquid, okay? They can be converted to cash within a short term with no or little risk, okay? Cash balance can be negative, okay? I hope it doesn't happen to you, okay? I hope your cash balance is always positive, okay? In fact, the larger the better, okay? So, but it could happen when I was a poor student, so it could happen. Your cash balance can be negative, okay? So hopefully that doesn't stay for too long. Okay, so that's the inclusion. What about the exclusion? What is not considered as cash and cash equivalent? So for example, you have a cash has a designated purpose for use in the sinking fund, okay? Okay, so it's only in one account, okay? It can be only used for a special purpose, okay? So it's not available for any other uses, okay? Okay, so then this is not considered as cash, okay? This is not considered as cash because of the restrictions, right? You think about cash, you have the cash, right? If you want to buy anything, you can buy, right? With cash, you want to buy equipment, inventory, whatever, right? There's no restrictions. But if the cash, okay, is put into a sinking fund, okay, they are not available for the other uses. They are not considered as current asset, okay? They are not considered as current asset. So therefore, you don't classify this as the CCE, okay? And also some of the financial investment, okay? They are, for example, maybe shares, right? Maybe you buy some shares from the stock exchange market, right? Those are not considered. They are current asset, right? You can sell them, right? You can sell them with no problems, right? But the risk is high, right? The share price can change dramatically on a daily basis, right? When Mr. Trump announced about his COVID infection, and what happened is the stock exchange just plummet, right? And then when he recently announced he's okay, he's back, right? And then the market go up again, right? So can you think like how much change has happened, right? So this is very risky, right? When you're investing into stock market, exchange market, it's quite risky. So even though the shares you are holding can be considered as a current asset, right? And in fact, you can sell it very easily, right? There is a lot of other investors are buying, selling, lots of transactions every day, right? So you can convert it to cash very, very conveniently, very easily. But would you get the same amount of value? Maybe not, right? Just because that price is changes dramatically every day, right? Because of that, so you do not include this kind of financial investment as a CCE, okay? As a cash equivalent. Any questions? Okay, good. Cash held in foreign currencies. So the general kind of thought is that, you know, we think all these foreign currencies can be easily converted to Canadian money and with no or little risk. If that's the case, okay, then it's good, right? Then you can consider the cashes in foreign currencies as a CCE, because you can easily convert the foreign currency to Canadian dollars. And suppose the exchange rate is very stable, right? It does not, changes dramatically. So then you can consider these cashes held in foreign currencies as CCE. However, not all the foreign currencies fall into this category. Okay, so certain currencies have a high inflation, right? Okay, certain countries have very, very high inflation. Do you know what's the inflation in Canada? Does anyone know? What's the rough number inflation in Canada? What's the goal of Canadian government to maintain the inflation rate?
Like 2%?
Oh yeah, very good, 2%. Yeah, very good. So the minute if it's over 3%, then guess what? Then the government is going to control the availability of the cash, right? So the idea is they try to make it to be in an ideal range around maybe 2%. That's in Canada, right? But this, I'm going to show you a graph, okay? I Googled today. So as of April 2020, so this graph shows the top 10 countries with the highest inflation rate, okay? And the number one is Venezuela, okay? 15,000% of inflation. Wow. So if the house, okay, think about this, right? If the house is $100 in April 2019, right? And then in 2020, 1 year later, it's gonna be like 15,000, okay? $15,000. So if this is the case, the currency, your money held in the Venezuela currency should not be considered as CCE, right? Because that's crazy, that exchange rate, okay? Zimbabwe, right? Zimbabwe is 320%, so it's so crazy. Yeah, so even Lebanon is 17%, right? So the inflation rate is very, very high. That means if you have money you deposit to Lebanon, the annual interest income will be at least 20%, okay? Will be at least 20%. Because inflation reflecting your interest rate, right? Reflecting your interest rate. Okay, so I guess, not every foreign currencies can be treated the same way. You have to use your professional judgment. For currencies with high inflations, okay, if the exchange rate with Canadian dollars is very unstable, those money in the foreign currencies will not be considered as cash CCE. Okay, do we have any questions?
Yeah, I got a question.
Mm-hmm.
Do most countries try and aim for 2%, or is that just Canada's decided goal?
Yeah, that's Canadians' goal. But I think most countries wants to maintain, if 3, 4, I mean, but 17%, that's too high. Yeah. That is too high. Whatever happened is, when the government start printing money, that's the time we're gonna have high inflation. Okay, so recently in Vancouver, right now we are in the midst of COVID, right? I think Calgary is highly affected by COVID, right? Maybe the housing market is down a little bit, right? But in Vancouver, in the last 4 months, May, June till September, the housing price has increased a lot. Okay, in January, a house would sell for maybe, let's say, maybe 110,000. Okay, sorry, no, $1.1 million. My good wish. Okay, 1.1 millions. And right now they are sold for 1.2. Okay, so just a couple of months, there's like $100,000 difference in price. And why, right? You want to think about why. We're in the middle of COVID, right? Why And the reason for that is the government is trying, they are, the interest rate is really low now, right? The interest rate is very low. And, so people want to take advantage of that. They are willing to get more loans, right? So that pushed the housing price up. So you want to keep it at a reasonable low percentage, okay? So that people can afford to borrow money. So because in order to grow the economy, someone has to invest, right? We have to have business entrepreneurs borrowing money from a bank, investing into the economies, right? If it's too high, then if the interest rate is too high, everyone would want to just put their money into the saving account, right? Just to earn the interest income. Why would you take the risk of doing business, right? So that's why I think they need to achieve a balance to encourage, has to be low enough to encourage economic development, but not high enough causing inflations, right? If you cause inflations, the problem is, for the average person, our salary does not pace up as much, as quickly as the inflation rate. So then we are in trouble. So basically, we are making less money every year, right? If our salary raise does not pace up with the inflation, okay? So what's your annual salary raise? Maybe 2%, 3%, right? So that's just to compensate for the inflation. So you still make the same amount of money. The reason you have a raise is to compensate for the inflation, right? So if the inflation is 10% and your raise is only 5%, so your buying power is weakened this year compared to last year. Did I answer your question, Mitch?
Yep, that answered it.
Yeah. Anyone else? Okay, I will move on. Okay, so if it's a negative balance, okay, it's overdraft, right? Overdraft. So you do not think, oh yeah, overdraft credit balance, maybe I should classify this as a liability. You will do that only if this is the only account, okay? If you have some other, the company may have a cash account from different banks, HSBC, BMO, Scotiabank. If in one bank you have an overdraft, but for the other bank's accounts you have a large balance, so you just report the net, right? Okay, you report this overdraft as a deduction from the other balance. You do not separate this credit balance as a liability. Okay, you do so only if this is only a bank account. Okay. Implications for the cash flow statement. Remember, when we prepare the cash flow statement, we try to understand the changes in the CCE, the cash and the cash equivalents, right? So there's opening balance, there's ending balance, and there's a change. So when I prepare the cash flow statement, that helps me understand why there's such a change, right? So basically, when you are exchange between a CCE with a non-CCE, and that's going to result a cash flow, okay? If you exchange one CCE with another CCE, okay, so your total CCE doesn't change.